the share screen. So I show here how to begin the conversation. You see this on your screen, right, April? I can see you. The four green dots.
Yes, I can.
So I say, listen, at the bottom it says, will the right amount of money show up at the right time? There's only four areas that we studied when you look at the life cycle of a human being in Canada or an adult in Canada. And the way they run out of money, or the days they really need money, is if someone passes away, they need some insurance. Or if there's a health issue, they need some insurance. Or if they spend too much on debt, they need a refinance, to get out of debt. Or if they become elderly, they need money for retirement. And so there's really four areas we run out of money: overconsumption, we pass away early, or we lose our health. And so a lot of times I tell them, hey, a lot of advisors sell life insurance because it's easy. If you pay and you pass away, they pay. It's easy to understand. And there's not a lot of rules to it. But health insurance is a little different. So I asked the client, I want to make you bulletproof. My goal is not to make you rich, it's to make you bulletproof. And one of the things we do is if you lose your income, it's devastating. And so if you lose your health, you usually lose your income as well. And so I say there's two types, if I'm going through this, I say there's two types of health planning that we sell Canadians. One is critical illness and the other is disability. And they're two different purposes. One I don't think is more important than the other. And but most in the financial industry, our competitors, very few people can sell investments, life insurance, critical illness, and disability. Very few. In fact, not enough. And what I want to do is I want to show you how to build these plans. And then I want to show you some examples of plans. Does that sound good, April? So when I talk about critical illness, the concept that we have to agree on before we go into a quote or before we show numbers is to say, hey, listen, some people get cancer. Some people have a heart attack or get Parkinson's or multiple sclerosis. And usually when they get a disease like that, a dreaded disease or a critical or major illness, they're usually surprised. Would you agree, April?
Yep, I agree.
I don't ever met anybody. I met the guy, he's 74, he had cancer in his 60s, and he says, I was shocked when they told me. And basically everybody's shocked when they find out. There's no one who says, oh, I knew it was going to happen to me. And so we buy insurance for recovery. So if I had cancer, it usually costs our family a lot of money. And so we buy insurance in case that happens, the right amount of money shows up. And so we ask the client, would you be okay if you got cancer, if you got a lump sum of money showing up, or if you had a heart attack, you got a major illness? And they say, yeah, I'm interested in that. If they say, I'm not interested, I don't think I'll get cancer, we just don't proceed. If you continue to proceed, they won't make the sale anyways. You have to help them understand the concept of insurance for critical illness, which is mostly cancer and a lot of heart disease as well. And here's how we build it. Once they say, hey, I like critical illness, we look at how to build it. There's different levers we can pull to affect the price. Now with critical illness, there's two main levers. One is how much coverage you get. So when I'm selling a critical illness policy, you get to decide the amount before you know what you need. And if you decide too small, that's what you get. If you decide too much, that's what you get. It's the only insurance that you can actually benefit from. I got a client who had a heart attack on a Friday, went to the hospital. On Monday, he was on light duties. By the end of the week, he was back to work. But his policy paid out. And so most policies are between $50,000 and $250,000. And we asked the client, hey, when was the last time you had $50,000 or $100,000 or $500,000 in your bank account? For most Canadians, it's never. But if you got sick, you need it. And so let's go through the field application tip. You must give the client a tangible reason for the benefit you quote. I can't tell April, you need 100 grand because you're young and it's cheap. You need 200 grand because young and it's cheap. Nobody wants to feel like they're getting rich off critical illness. And I use a piece like this from the FNA. Looks like this. This is built to match our FNA. By the way, if you need it, you email me. I'll email you this piece. And it's built out of Excel, and you can fill it in. And this is typical. I'd say, if I want to provide income for 12 months for the client, $35,000. And I provide income for the spouse for 12 months. Or if I got cancer, I wouldn't work and my wife wouldn't work. Maybe travel. If I had a heart attack, I'd go take a vacation. Pay off present debt if someone has some debt. And then cover timely or non-insured treatment outside Canada. So if you travel south to the States, you can pay for treatment or pay to get a diagnosis and then come back up and get some treatment. And then maybe modify your home or your vehicle, put a chair or a ramp in. And so this needs analysis. I'd say if you want all of this stuff, it's $145,000. And just like the F&A on the life side, I'd say you have a $10,000 policy at work, so you probably need $135,000 to top up your coverage. Now, not everyone buys what they need. You could buy $100,000, $50,000. But if you were to buy all these, this is what it would look like. And then we can put a price to this. Does that make sense, April? And then, by the way, if you write down what they need, they believe it. If I write it on a piece of paper, they don't believe it. So I got to put it in here, and I just insert this into the F&A when I'm delivering it back to the client. And but I want to give them the reasons why they need a big coverage. And when I look at some of the other averages here, we can look at the brochure. This is an equitable brochure, and it shows different claims. So a $50,000, $100,000, $100,000, $50,000, $100,000. You know, someone got 34 at a brain tumor at 200,000. Nobody expected to get these things, and the average claim is 70,000. So when I look at how much coverage they buy, the next number is, do I buy term or do I buy permanent? And term and permanent is very similar to life insurance. It doesn't go up as quick with critical illness because that starts off quite expensive. But you know, do I take a 10 or 20-year term, or do I lock it until age 70 to 100? The 75 or 100 we consider permanent, and a 10 or 20-year we consider term. It depends how long you're going to keep it. That's why you choose. So, for example, if there's a 35-year-old, here's an example. If they buy a 10-year term for $100,000, it's $33. So the client puts out $33. If they get a dreaded disease or a critical illness, they get $100,000 tax-free. They can lock in that premium. They can lock in that premium for $87 a month as well. So then they got the coverage all the way till age 75. Most of the critical illness claims are going to happen between 55 and 75. So when someone's a little older. Or they can buy a term 10 for same premium, but they can get more coverage. So you can look at, hey, if I want to spend 87, I could get a term 10 and get a $281,000 policy, right? By the way, if you show someone the numbers, the client can help make their choice, right? If I look at a 45-year-old, a permanent with a return of premium is $128, and or a term to 100, 104. So a lot of policies are between $50 and $200. But you can extend a 10-year term to a level of 75 or to a level to 100, usually at any time with most of our carriers. So if they don't know, they can buy it short term and then extend it later when they pay off their debt. But those are the two levers we pull: how much coverage and is it term versus permanent. This is one that's not always discussed here: is do I buy insurance on myself or do I buy it on my family member? Where I have more critical illness on my son than I do myself, because if I got sick and I had to choose between different medications, I could figure that out. But I don't want to make that decision for my son. He's 2 years old and he's like everything to me. And so if a child gets cancer, what are your options to come up with funds? So what's the needs analysis for a child? So if I'm asking April, and I'd ask, hey, how much equity is in your parents' house? Or how much equity is in your bloodline above you with all your parents? That's how much you should buy critical illness for. So you don't have to borrow all the money from them. Or if my parents have a $250,000 house paid off, I buy a $250,000 policy. And this is what it looks like on a child. So if I buy a $250,000 on a 1-year-old, so they're new baby, it's $57 a month. Now, after 10 years, it's a 10-year term, it stays at $57 because the risk doesn't go up for a baby. A 10-year-old is actually less risk than a 0-year-old. So the renewal is at $57. At 20-year-old, it's 52. So on my son, I'll pay 57 for 10 years, then 57 another 10 years, then 52 for the third decade. And then it's 66 when my son turns 40 and he can take it over at that point. But a $250,000 makes a big difference if someone gets sick. There's a million charities out there trying to help, if something goes drastically wrong. But I like to put in critical illness on a child before life insurance, because for me, it's a worse impact to not have, to get a dreaded disease on my son and not have the money to take care of it. And then one of the troubles is that, do I do a standalone CI or do I do a combo when I'm selling it? Or if I got a life insurance commitment of $200, do I just add a $50 CI on top of it? And here's my notes: is they usually look at the total cost. They have a mental budget. So my clients have a mental budget. They say we're not going to go over 200. If it's over 200, we decline. Or if it's over this, we decline. And so I want to stack the commitment. So I'm selling it. I got to sell the life insurance. Then I got to educate them and resell them on the concept of critical illness. And so usually they don't buy unless it's sold properly. So many times they buy 3 to 6 months later. So I included in my notes, say, hey, this is what we're going to have to do later. And then I come back to it later when they got used to their life insurance premium. And if you want to compete and differentiate, I think that's how you say that, start with CI. A lot of our competitors start with life insurance. Start with CI. Say, hey, let's protect if something goes wrong first, because it's unique to them. If someone's been seen the presentation many times, start with CI. And but that's a little bit about CI. I don't have my chat open. 1 second. A little bit of Q&A. Let me open this for a second so I can see. Any questions there, April?
Yep, there was actually a question right here, which is a very fair question. Is there something better than Manulife Synergy that covers critical illness and disability and life?
Yeah, they got the trio synergy. I was looking at that today, actually. And one of the problems is better is not a financial term, but suitable is. So is there something more suitable? It all depends on the client. Let's say they got a job and they got disability insurance at the job. Disability won't double pay. So if they have a job with disability, they're not going to get double paid on the disability. And or they want to customize different plans and maybe get the, Manulife, their term is slightly more expensive than some of our competitors. And so maybe they don't want to overpay for one or the other, but everybody's got very competitive things. It's not like there's no good answer. What's better is me. They get me and my advice, but it's very competitive out there. We agree that business is competitive. So, someone asked, is there a return of premium on death? I don't want to get too much of into product, but a return of premium is death while the policy is in force. And so if someone outlives a term policy, a term till 75, the return of premium on death does not pay, is my understanding. But let's move on and let's go through disability, and then I'll come back and show some of the options on how we quote CI and how we'll kind of bounce around a little bit. Does that work?
Yep, that works.
So the disability, and I see some questions about product specific stuff. Just read the contract. A lot of times, if you've read the contract, the questions go away, and every contract's slightly different too. But disability, here's how we quote a disability. First off, they have to want disability before we quote. If we quote before they want it, the quote means nothing. And so when we start off, I have a quoting page I use. I can show you that. But we want to show how to build a disability policy. And the way we sell it is say, hey, if you couldn't work because of an injury or an illness, then the insurance company will pay your bills for you so you don't go bankrupt and become impoverished, right? And so when it comes to disability, we're going to come back to more questions if you ask them, so keep asking them. So when it comes to disability, there's different levers we can pull to control the price of the contract, depending on the health of the client. And so the health of the client matters, and what they're willing to pay matters, and how much medical are they willing to do. And so the first question we always have is it non-cancelable or is it guaranteed renewable? There are two different worlds where non-cancelable means fully underwritten, do the medical now. Almost all the life insurance we sell is non-cancelable. Simple issue is like on the life insurance side, a CPP or a Sure and Go, and you get the policy now, it's issued in a few days, and then you complete the medical when you claim. They double check your medical questions. And so I prefer to sell non-cancelable upfront almost all the time. And it's harder to get. There's more headache. If you have staff, they have more follow-up to do. But a lot of the competition out there who is full-time selling disability, they go into a business, they sell simple issue, they never go back. And so we want to make sure the client can process the claim when they process that claim. And non-cancelable is fully underwritten. Simple issues, similar to mortgage insurance, they just double check later. And so we're gonna let the client know, these are the options. Do you want to do like some medical questions? We ask about your health history. If you buy more than 6,000 of coverage, they do a blood test, all that kind of stuff. Now, how much coverage? Once I know the contract, we're going to say, hey, how much coverage do you need? Usually you want to buy the coverage that matches their expenses. So if your expenses are equal to 100% of your income, that's how much disability you want to buy. And you're limited on how you buy it. So you're allowed to buy 65% of your income, up to 25,000. And you're also allowed 20% of your income for retirement. So you can do a top up there. You can do business overhead. So if I have like rent in my office or different things, I can cover that. And then I can also cover more coverage later. So I can increase my coverage later. I can cover my mortgage and I can cover debts. So I can stack a bunch of different policies that cover different things. And I can get my coverage all the way up. And here's an example. For example, this is a policy where it's I can buy an $86 policy and it's a $3,000 benefit. But I can also spend an extra $19 and get an $800 benefit to save for retirement. So if I got disabled, I get my $3,000 to live on, plus I get $800 to pay me until retirement. And because after 65, the disability stops paying. So I have to have money saved or I become a really poor 66-year-old. And so I can say, hey, a little bit more, I get a little more coverage. And so I can stack it up. If I want to buy more, I pay more, I get more. I pay less, I get less. And so if someone wants to pay less, usually we have to strip out some of the benefits. And once they understand that, it's very easy. The how much can I buy? How long do I want to get paid for? And so the claim is going to last until the insured is no longer disabled or the benefit runs out. So short term is usually 2 to 5 years. Long term is age 65 or till age 70. And so I can say, if you just want to make, if you get injured, a lot of young people worry about getting an injury. So if I slip and, get hurt or, get injured for a couple months, 6 months to a year, 2 years is really good for injury. But if I get an illness, maybe I want to be covered till age 65. And different premiums. So if I buy a 2-year benefit, this is a 35-year-old with $3,000. All my examples are 35-year-old male, $3,000 coverage. It's $41. A 5-year term is $59, and an age 65 is $86. So the best price is usually the 5 or 65. But let the client decide. If they want to say, I want to save as much as I can and buy more later. The other lever we can pull is the waiting period. So the shorter the waiting period, the more the client's going to pay. The longer the waiting period, the less they're going to pay. And the waiting period should match their available funds. So if someone is poor and they have no emergency fund, they have to pay more for the disability policy. It's expensive to be poor. If they built a big emergency fund, we can discount their policy by extending out their waiting period. So 0 day, if they're worried about small injuries, it pays on day 1 or 2. Now we got to be careful because it usually takes about 30 days to file a claim. So if someone calls you and they hit their finger with a hammer and they can't work for 2 days, they won't get paid on the 2nd day because we have to file the claim, which takes about 30 days. That's why most waiting periods are 30 days or 90 days. And 30 days if they have no emergency funds. 90 days is usually the best price. And then EI in most provinces, I'm in Manitoba, it lasts 119 days. So 120-day waiting period is an EI offset. And then 720-day, if you have a group plan at work that's short term, you get a 2-year waiting period and you take your long-term personal. So the waiting period should match their financial situation. And then so I can kind of pull these levers and I can show you how we build it. And then I can look at, hey, what else is available? If they don't buy it, they don't buy a personal plan, who takes care of them? That's always the question. So in Canada, we have CPP disability, and it's $13.87 a month, only for severe and prolonged disability. And severe means that you have a mental and physical disability that regularly stops you from doing any type of substantial or substantially gainful work. And prolonged means it's not going to go away. So it's tough to get them. And the other thing they look at is, hey, if I can't get that, maybe I get employment insurance. This is great, but it's only up to 15 weeks. What do you do after 15 weeks? You know, it's only to bridge the gap between jobs. And it's only $500 a week. Then we have a workers' compensation. This one's really solid. It's 90% of your income, but you gotta be, or injury has to be caused due to work. So it's usually an accident, but not an illness. But if you get an illness due to work, it'll pay as well. And they also cover healthcare and then dental costs. So it comes with a dental plan. And then some policies can be converted to long-term care. So RBC's policy, they can convert some of them to long-term care up to $6,000 a month. And so we want to get to the Americans sell long-term care very well. If we want to, we can. And then this is an example policy we're looking at of if someone has a $50,000 income and they want a $3,000 benefit, 90-day waiting period, payable till age 65. So the benefit's payable to age 65. It's $86 a month. And this is an easy policy for someone making 50 grand a year to put 2% of their income to guarantee their income. And the illustration, it shows here, if they were disabled at age 35, they pay out $1 million in disability payments. If they were disabled at age 50, they'd pay out $500,000 in disability payments. And the probability of a disability is quite high. So we just look at the stuff, and then that's how you build a disability plan. Those are the levers we pull. And let me show you some examples. So this is another sheet I stick in my FNA. And what it allows me to do is to build a policy. I almost always built a disability policy in front of the client. It is, I've never built it and then go and say, like with life insurance, they can give you a budget, you can give them what they need. It's pretty cut and dry what they want. But as I'm going through this, I tell them, hey, we can build this however you want. And this is exactly how I do it. So if April is participating here, I'd say, April, if you need coverage, one of the first questions before we buy a policy is, do you have any medical history? Because if you have medical history, we can sell you a policy. They double check your medical later, and you can't get any payout or anything you already currently have. But if there's no medical history, we can get you covered for everything. So I ask them, do you have any medical history? And if not, we want to start with non-cancelable. It's the gold standard in the disability industry. And there's a lot of controversy in the financial industry, but there's no controversy that non-cancelable is the gold standard when it comes to disability. And then I say, hey, April, if you got disabled, do you want to just count if it's an accident, like if you slip on the ice and get hurt? Or do you want illness covered as well? And so I'll show you the levers. And then we want to look at what's included and not included, where some include soft tissue and mental illness. Mental illness, just so you know, accounts for more claims than heart attack on the life insurance side. And what I mean by that is suicide. More people claim life insurance from suicide than they do heart attack. And so it's an issue. People have a mental illness, right? I'm not making light of it, but if you can't work, you could take time off. So if I ask, let's have a conversation quick, April, and go through it like I'm going through with a client.
Yep, sure.
So I'd say, April, do you like to be covered for both, or are you just worried about one or the other?
Ideally, I'd like both.
So I'd just say no problem. Let's start with both, and if it's too expensive, we'll cut stuff out.
Okay.
But I like to cut stuff out at the top, not the bottom.
Mm-hmm.
Now, the amount of coverage, if someone says they need $3,000 of expenses to survive, and a lot of times the more income they have, you just ask them, how much coverage would you need to survive? What kind of lifestyle do you want to live? And I'd say, let's start with covering your income. And if you make $5,000 a month, we can buy you a $3,000 a month policy, no problem. And then if you want to cover your mortgage, we could do that too. I said, do you currently have disability on your mortgage? If they do, I do 2 disability policies, a mortgage one and an income one.
Yeah.
Simple, right?
Mm-hmm.
And then I'd say the length of the benefit, if you did get disabled and it was long-term, multiple sclerosis, or you had something you didn't like, you got surprised, would you want your income to last till 65, or do you want to just have a couple of years and then that's it?
Longer, till 65.
Usually people only buy a 2-year or 5-year at their employer level, because the employer pays for it. They say, hey, we got disability, 2-year disability, but they got disability because they can kind of appease someone and have them move out the door a little bit. But the most robust is till age 65. A lot of AxioJet or fundamental policies that are very simple issue, they're usually short term because they're going to be upgraded later. And then the waiting period, I just ask, hey, how much cash do you have available, either in credit card, equity in your house, that you could get within a week or two to pay some bills? How many days or months do you have available?
90, 120 days.
Yeah, perfect. So I say 90 is the most efficient price. Do you have unemployment at work? So if you have unemployment insurance, then we'll do a 120-day waiting period, because unemployment will pay for 119 days, and then our policy will kick in at 120 days. So that's what I do with unemployment. If you have it, 120-day waiting period. If you don't have it, 30, 90-day waiting period. I usually start with 30. And so this is how we build it. I don't want to go through the quoting software. You can go to the companies we use, and you can check all the quoting software. I see some of the questions about LifeCheck Basic and Manulife and different policies. A lot of that, I skip some questions that are in the brochure. I expect we're all brochure, we know how to find the brochures. But this is how I build it. And then I just show here, if someone has one at work, I ask them, what do you have at work right now? Nothing, something, whatever it is. And then definition of disability. So I do a full definition. That's what I want to start with. What says accident, illness, mental illness, and soft tissue. I want to cover any. If the doctor says you can't go to work, we pay out. So no exceptions. That's what I want to start with. Then I want to say amount of coverage. Could you survive on 3,000 or 4,000 or 5,000? How much coverage do you need? And I'll figure out how to get that kind of coverage. That make sense, April? Then I want to look at here and say the length of the benefit. Do you feel like if you were to get an illness, you'd be able to recover in 2 to 5 years, or would you want to have a permanent policy?
Permanent.
So then I want to put age 65 here. And then I'll show you the price of something smaller. And then the waiting period, you said you could cover 90 days. They're good here. And so one of the things I look at, if I'm going to adjust the price, maybe we look at the length of the benefit, if it's too much price. And then I show the quote, and I say, this is going to cost you whatever it is, 80 bucks a month. I run the quote, I figure it out, 80 bucks a month. I usually just change colors, and I say, if you were to buy a 5-year plan, then it would cost you 60 bucks a month. I just write it right in there and say 80 bucks a month for the right one. If you want a little cheaper, just a 5-year plan, it's 60 bucks. I just threw those numbers out. And then we just got to build it together with the client. And they're usually engaging with me. If they're not engaging, usually they don't want to buy. So they're just like running around, right? Making you run around. And then I review the government programs. I say employment insurance is only 15 weeks. Now it's good to have, but it's only 15 weeks. CPP is only severe or prolonged. And workers' comp must be caused at work. So they all have limitation. When you own a policy, you choose the limitations. And so here we choose no limitations. And sometimes it's hard to get an income or depending on the career. But that's how I build. That's how I build a disability policy. And then I say, if your income is, here's how I close it. I say, if your income is $50,000, if your income is $50,000, only until you get disabled, you're going to pay $1,000 a year in this policy, $49,000, but your income is going to be forever. So I'll take a little less income to make sure my income lasts forever, until 65. So I buy insurance for the same reason I recruit and sell securities, so I can have secure income. And that's why it's $1,000 a month or $1,000 a year. But that's my disability builder process. And those are the levers I can pull. And then I just show them the quoting software and I make some adjustments and go from there. Is there any questions on how I build a policy in front of the client?
Daniel, I believe the disability questions are still going to come in. But if you want to entertain, do you want to entertain the critical illness questions? There's actually quite a few critical illness questions. So
I will,
what was that?
Entertain them after. I'm going to go through a little bit more critical illness.
Okay, sure. Do you want to go through more and then answer
I'm
these?
going to go through a couple examples, and then we can look at kind of how we're selling to different people. I usually sell disability. I present it to everybody. And then they can choose whether they want it or not. And then with critical illness, I also want to present that, but disability is for a long-term where it's a catastrophe. You can't go to work. It saves them from bankruptcy. Critical illness is recovery benefit. So I want to recover from a heart attack faster so I can recover faster. My wife had an injury, she had a knee injury when we first got married 16 years ago, and it took about a year to fix it. But she had the same injury about 2 years ago, but I could afford to go to physiotherapy every day for her. So it took like 2 weeks to fix it, 3 weeks, because she could get the right healthcare. And that's what the critical illness. We didn't have critical illness for a knee injury, but having money gives you access to the right information. Let me show you. I might answer some of the critical illness questions. Let me show you. This is now I'm going to move back to critical illness, and this is a child policy. I sell a lot of these. I own something almost like this, and this is a benefit of a $250,000 benefit, and it's $57 a month. It's so inexpensive. And I just say, hey, listen, this is to cover the worst case scenario that could ever happen. You know, worse than my wife passing away is if my child gets sick, right? And then I just show the premium. The reason I buy a 10-year term, $57. Then after 10 years, it goes down to $56. Then after 20 years, it goes down to $53, and then starts going back up. So a 10-year term starts going down for a child and starts going up around age 30. And because a 20-year-old doesn't get leukemia as much as a 5-year-old. So that's a child policy. And I started at $250,000, and if they want $100,000, I drop it a little bit. But I think everyone should be presented with this and they can make their choice. I think it's inexpensive. I lost my Q&A. 1 second.
There's a couple of participants as well that raised their hand, Jeanette and Jenilyn. So Jeanette and Jenilyn, if you have any questions, you can type it in at the Q&A or at the chat.
Yeah, let's go through some questions. And then I got a couple more policies I can show. But once someone believes in the concept, just give them the price and they pay or they don't pay. It's good. You know, they say, give anything half price, you just make it half price. You say, yeah, half coverage, right? Let's go through some of the questions. Do you have some of the questions there, April?
Yeah, I'll answer. I'll actually pick out a few which I think are really amazing. All of them are amazing. So Lorena asked, if a client has a full-time job and a part-time job, both with benefits, when would his personal disability kick in?
So if a doctor says you can't go to work, or you got to go to work with a half your income. So it's if they get disabled and can't go to work, and it depends on the contract. So you can do any occupation, a regular occupation, or your own occupation. So when you buy the policy, it's set out in the contract. Some are any occupation, some are regular, and some are your own occupation. So that question depends on the contract, what type of contract you bought, but everybody's different.
Depending on the contract then, and this what if it's illness or disability or accident. Okay, this actually this is one thing. Let me just see here. Surya asks, can critical illness claim multiple times if heart attack occurred 2 times, or cancer and then heart attack later? This is amazing.
So when you pay out a contract, the contract's closed. Now you can buy contracts that say and or like CPP has one. It won't pay twice for a heart attack because it's not the way it works. So the contract pays out. It's like life insurance; it pays out once. If you buy a contract with 2 payments on it, where you have a heart attack and cancer, or you can do that at CPP has one. I'm not sure if Shermanville has one. Manulife is very unique in the marketplace. I don't know as much about Manulife as I could know. But it's one payment. I don't want half the payment now, half the payment later. Or if I buy 100 grand and I get cancer, I get 100 grand. But good question. A lot of clients ask that question.
Yes. Let's just see here. There's disability and critical illness questions. Which one do you want to answer?
Either one. I think of health benefits. It's 2 sides to the same coin. We should present both of them to the client. Some think they're going to get disabled, and so I present them in the same motion with the client. Just like I present term life and whole life together, I present CI and DI as 2 sides of the same purchase.
All right, so let me just see here. So Stacy actually said, is the money back guarantee on ROP upon death during the term only? To be specific, if I have a T75 CI and I die at age 76, will my family get the return premium?
Nope, they won't. Let me show you a return of premium. And I usually sell return of premium to people who have not had a lot of exposure to the stock market in their lifetime. And usually if they're single. If someone hasn't been in the stock market, let's say I bump into someone, let me look at my client here, I'm going to show you. This is an example. All the ones I show you, I put in place, or I use as my example. But this is an example where that is a 30-year-old female, and this isn't a return of premium, but I'll show you 2 examples here. I can say this is a 20 pay. So they pay $138 times 20, 20 years, and they get 100,000 of coverage. And so this is one of the things I say, hey, listen, if you're a 30-year-old female, it's $144 a month. And here's how the payout works. You pay your premium for 20 years, but you have your coverage forever. In fact, you have your coverage till age 100. And you also get a return of premium on death. So if I pass away, my client gets their 34,000 back. But if the client gets a critical illness, they get 100,000. And I usually use this as a retirement benefit, where if they go into retirement as a single female, who's going to take care of them? And this is like, if I work until I get sick, then I have a year or 2 of income to take care of myself. And so if someone says, my goal is to take care of myself in the future, then critical illness allows them to do that. So it's a savings program. You don't get any interest on the savings, but if you got sick, you get $100,000. And it's almost like if you save the program, if you got sick, they'll pay you what you would have put in, plus a lifetime of interest. And so this is a paid up plan. When you bump into a paid up plan, they're very difficult to replace unless you catch them in the first couple of months. But I got some paid up insurance. I'm 7 or 8 years into it. I'll never replace it because I'm on the way. This is oh, I think that's it for my. I don't have a return to premium on here, but return to premium is very simple. Where if I say, hey, you're going to pay a policy, the risk of CI is you don't claim. So I say, what if April buys a policy but doesn't claim? Well, that's okay. If you don't claim, you get your money back. And so that's someone who has good cash flow. If they don't claim, they get their money back. And a lot of people like getting their money back. So I can show them, if you want a permanent policy, you get your money back. And they say, I like that. And they can do it as like a forced savings program, kind of like a bond portion of their investment portion. So a small portion of what they're totally saving. It shouldn't be 100% what they're saving, but it should be it should be a substantial amount, a couple $100 a month. That's kind of what I look at. What other questions we have?
We have quite a few. I
Okay.
think one of the revolving ones that come across is, let's just see here. So how does LifeCheck Basic Critical Illness compare to Manulife Synergy? So I don't know if you have any information about that, or we can maybe deflect this at the very end.
I want to flag that question where when you ask it to compare a specific product, you can't compare a product without a client. So we can't, I can't answer that question because I can say, how does whole life compare to term? It all depends on the client. It all depends on lots of things. But, and I just don't know if that's our purpose today. I don't want to go into that too much. I don't know a whole lot about the Manulife because it's a competitor product. But
all right,
read the contracts and you just compare. And then you put a little note in the community and then we'll read it. So.
Good. This one is actually a question for you from Maria. Why do you offer disability to everybody?
So I have a colleague in the financial industry who had a client, and I had a couple of clients that are just so good. If I say, hey, you got $1 million term, you got a raise, you need a little more, and they buy what I ask. I say, hey, you're saving $500 a month. You want to save $550 or $600 a month, and they increase their pack every time we do a review. Really good clients, very healthy financially. And those are my favorite clients, you know, where they're very healthy financially and they listen, they go into workshops. And this colleague of mine doesn't work at WFG, but he had one of those clients and he sold them everything. And his whole financial was set up. And then that client called him one day and said, hey, buddy, you're one of my good friends. A lot of our clients become. And I got multiple sclerosis. He says, I got diagnosed with multiple sclerosis. I can't go to work. And he says, every time you came over and offered me insurance, I bought it. I'm just calling to double check that I'm going to be okay. And this advisor never talked to him about disability. And so that guy has no income. You basically, you know, if you got multiple, you got to find a spouse or find a parent or find a child to live with. And, you know, you got to go back to the nuclear family. And so I hear stories like that and I think, why wouldn't I present to everybody? That's my job. And so I present to everyone I can. And I say, hey, in a review, let's look at how disability is priced, just so if you ever make a decision to buy, you know how it's priced. I build them a plan. I say, this is how it's priced. I say, when in your, you know, would you like to buy this year, next year? When do you think it's time to buy a disability policy? And then we have a conversation about it. But it's a major tragedy when someone has an advisor and then they have a catastrophe happen in their health and they weren't exposed to the product. That's my fault. Now, if I present it and they get disabled, that's not my fault. That's their fault. They're an adult. I don't feel any guilt about that. But, I presented life insurance. People didn't buy it and they passed away. I have no guilt. Maybe I could do a better job. But, man, if I don't present a product, someone gets Parkinson's, multiple sclerosis, it's a lot of money we're betting on. So that's why I present to everybody. I think you should too. And my competitors don't do it. So it's very hard to replace a good disability policy. You can't just, change the term and change the cash value and the investment and say, oh, you need something different. A good, robust disability policy is very hard to replace. So if I get a disability policy in place and the life and the critical illness and the investments and the mortgage and the travel insurance, and someone else comes out and they think they're better at one of those areas, I keep my clients. In the last 2 years, I've not had a policy replaced, and my persistency would be rounded up to 100%. And so I don't lose anything. So,
All
any other
right.
questions? I'll show
Yeah,
you one more policy I do on the corporate side, a corporate CI, what that looks like.
sure. There's actually a good question here from Maria, and I'll just add Jeff's on there too. So Maria said, if I have a full-time and a part-time job, can I claim my disability if I can work on my part-time? Let's say for modified work, just thinking disability might not cover both of my income. And Jeff asks, how do you usually top up policies?
Is that Jeff Aikenhead?
Yes, of course, that's Jeff Aikenhead.
Jeff Aikenhead. I was talking to Jeff last week, and we talked quite often. He said in his whole career, 10+ year career, he's never had a policy replaced by a competitor, and I think that's true. And so I like that kind of durability. I'll address Jeff's first, then I'll come back a little bit. But the way I address a top up is let me pull up my when I'm building, or instead of showing you, I'll draw it out. If someone has, let's say, a $2,000 benefit, I just dealt with a truck driver who has a disability policy, 65% of his income, max $2,000. So if he drives truck like crazy, the max he's going to get is $2,000. And I said, hey, how much coverage do you need? And I look at his expenses, and his expenses are $4,000 a month. So if he gets disabled, he's in deep trouble. So I say, what you need is $4,000 a month. What you have is $2,000 a month. So I'm not going to sell you a $4,000 policy because your group plan is going to pay out first. A group plan pays out before an individual plan. They won't double pay. And so I say, let's do a top-up plan of $2,000. And we can do a longer waiting period because you got some emergency fund. But I look at your total need, then I minus what you have at work, and then I do a top-up. And I can also do a top-up if someone has a good plan, like an engineer, federal employee. A lot of engineers have 65% of their income. So if they make $8,000 a month, they might have $5,000 a month in benefit. So what I do is I say, hey, why don't we, instead of covering your income, why don't we cover your mortgage and your retirement savings? I can do standalone retirement plan for 20% of their income. So if someone makes $10,000 a month, I can do a $2,000 a month retirement plan. So if they got disabled, we can fully fund a great retirement for them. They can use that, it goes cash into the bank. And so if they have something, I can look at what else they could afford and would allow them to get approved. Then I say, hey, you get approved for this. Looks like you can afford it. Do you want it? That's the best kind of salesperson ever. Hey, you could do you want it? Do you like this? Do you like that? Do you like this? And then next time we review, I review what they have and I try to show them one extra product every time. So I say, do you like this? They say, yeah. Do you want it? They say, yeah. Then I meet them again, do the paperwork. That's how I do a top up. I hope that helps. And then the previous question was about, do you remember the previous question, April?
Yeah. The previous question was basically if a person, full-time and a part-time, can they work part-time?
So they'll look at your pay stubs, and if you buy a partial disability policy for a regular occupation, you could work part-time, but it has to be in the contract. So when you apply, you have to say, I have this job, and this is what I'm earning, and then you have to maintain that current position. But and then it has to be a professional series or a superior series. It has to be a fully underwritten where we can get the partial on there. It all depends on that contract. Life insurance is sold on credibility and it's sold on belief. I got to believe in it. I got to have a kind of a credible appearance. Disability is sold on talking to lots of people and understanding the contracts. So you have to look at different contracts and figure out what are the exclusions. And life insurance, you have to be excited. Disability, you have to be a contract reader, which is that's the hard work on that disability. You got to read a bunch of contracts. That's part of becoming a professional. Any other pressing questions, or I'm going to show you a corporate CI?
Maybe just one more, because I saw 2 or 3 questions already. Do you put a return of premium rider for a child CI? So Rowena and Chantal, I believe, asked that.
I very rarely do. I don't want to buy I don't want to buy a permanent CI on a child because the term is cheaper for the first 40 years. And my son, when he's 40, he can pay for his own CI, and so I don't personally lock in a permanent on a CI. I'd rather buy more coverage. And I look at CI as like a return of premium is like a very low paying bond that has to be paid. So I have a cash flow risk to it. And if I have a 10-year CI and in 10 years, I can get $500,000, I might replace my CI on my child. But 75-year policy is a long time. And so I don't do a lot of permanent policies on a child. Now, my son owns a 10-year term for $250,000. So because that's what I own, I kind of got a bias. And I also think they're easy to replace. A lot of guys go out there, confuse their clients and replace it with a bigger, shorter term. And so I worry about other people replacing my stuff too. And so I don't do a lot of permanent on children. Now, most permanent policies on a child is meant to be sold. So you have it for 20 years, you cancel it, you get your money back, and then you buy another one. But I don't want to sell a policy with the intent to cancel it. So it's kind of like a gray area. I don't do a lot of them. I'd rather do a bigger benefit, myself personally, and use the money for a lot of other things. Please repeat that life insurance is sold on credibility. And you got to be a credible human being to sell life insurance. You can't, you got to look the part a little bit and speak the part. And if not, you just bring someone else who looks and speaks the part. But you got to be confident about what you're selling. It's something that's family's gonna get paid after they die, right? Let me show you what a corporate CI looks like. Is that fair, April? Do you sell a lot of corporate CI, April?
Not a lot. So you can show us how.
I like corporate CI. I study it lots because there's lots of money there. So when I look at, by the way, nobody talks about this kind of stuff. And so it's nice to have a policy that isn't talked about much. The requirements to get this is for someone to own a corporation. They're the owner of it and they're profitable. So they make money. If someone's the owner of a corporation and they're profitable, I've done with restaurants of this, I've done with medical doctors, different things. Hey, if you're in WFG, if Landon Ford's on here, Landon, this is for you maybe. I think he's very profitable, but here's what it looks like. Here's the problem in a corporation. If I have a corporation and I have $100 in my corporation, when I pull that money out of the corporation, I have to pull it out as income. And so if I pull it out as income, I end up with maybe 50%. Now we're rounding up drastically. People aren't paying 50% taxes. This is just a concept before the product. But it feels like 50%. So when you take money out, you end up with less money. Now the Rule 72 says, if I invest this money, I'm going to get back to 100% in maybe 7 years if I'm investing at 10%. If I'm investing aggressively, I can double my money in 7 years. And then if I put that into an RRSP, sometimes the business owner takes their personal money and does this to it, and they invest another 7 years, they end up with 200%. But because it's registered, they have to pay tax once, and they might have to pay tax again, and they're back to 100% of what they put in after 14 years. This is the problem of the business owner where they get so frustrated with the double tax. Now, they did get a refund when they put it in the RSP, and there is some ins and outs, but the concept is when I pull money out of the corporation, I get taxed. If I invest and the money grows, I do get taxed again. The percentage is different every time, but when I explain, you got money, 15 years later, same amount of money after the taxes. So, and they're working the whole time. So here's a plan. This is, let me show you what it looks like. This is a $500,000 critical illness plan. It's a permanent 25 illness plan. I usually start at 25 illness before I go to simple issue, if they don't qualify. And it's level to 75. The annual premium is $4,200. And the flexible return of premium is $3,000. So the company is going to pay into the policy $7,500. 7510. So $500 a month, $600 a month, they're going to put in. And here's how the tax works. Annual premium, $7,000 a year. So the company's got to make money. It can't just be like, scraping by. The insurance cost is $4,000, and the extra cost is your return of premium. And so if the client gets ill, it's a $500,000 benefit, which is usually what the business is worth. You say, hey, listen, if you get cancer, you get your money out of the business and you keep the business. After 15 years, they get 100% of their money back. So they put in 112,000. Now the corporation has to put in the 4,000, and the return of premium around 3,000 is a personal benefit. So they pay tax on that deposit every year. But this return of premium comes back to the person, not the company, because the person owns the return of premium, but the company owns the critical illness. It's called a corporate shared ownership critical illness. And so now the guy says, hey, wait a minute, I'm going to be depositing money for 15 years. And after 15 years, I get my money back, tax-free. That's the same as if I pulled it out, invested in RSP, and took a bunch of risk in the market. But that whole time, he has a $500,000 benefit. So there's two options. He claims $500,000, or he's healthy and he gets his 100 grand back. He can buy another one. What do you think of this, April? If someone has a profitable business, is this a good way to get money out? It's one of the only ways to get money out is through an insurance plan.
Absolutely.
Yeah. The max you can do is 2.5 million. I've done a policy like this with a $2.5 million benefit. The max at IA is 2.5. Different companies have different max on their CI. But, and then in 15 years, he's going to buy another one if he's still healthy, because he cancel, get his money out, and then move on. But this is a corporate, and then it goes down and it explains a little bit more in the illustration. It's in the IA software. But the main thing to understand is that this is a personal. He pays for that personally, and this is paid for by the corp. And then he owns the return of premium personally, so he gets that all out. So slick, especially if there's a health need, or he writes off all his income and doesn't have can't get a disability policy. If you write off all your income, you can't buy a good disability policy. Someone put in the notes a question, the money will get paid into the corporation, and return of premium, no, it goes personal. It's a person, you personally own it. The claim would go to the corporation. It would go into the capital dividend account, and they get paid out to the owner tax-free. Minus a little bit of NCPI would get deducted from that. But what do you think of the corporate CI, April? Is that cool?
It's really cool. I think a lot to take in. I think it's a little bit similar to how corporate accounts work too, right? Where the owner is the corporation. Is that true? And then whoever the shareholder is, let's say I'm the owner of the company, then I would be the insured. Is that how it works?
Yep.
Okay. All right.
You can company. Yeah.
Okay. Because Abel was asking and a similar question was, I think you answered this already, but just to confirm, who is the critical illness payout beneficiary for corporate CI? So the claim goes to the company, is that right?
The company. Yep. And then the company controls the money. Yep.
Okay.
By the way, if you want more information, go to IA. They got an incredible resource how to read about this. You can become an expert. You got to go through a lawyer to get a corporate agreement done and stuff like that. But it's the last one I did was over 50,000 in premium. So they're worth it to learn. It's not $100 premium. The company says, hey, we hate the taxman and we hate the market. Really? You hate the taxman and the market? Really? Wow. We have to do something that doesn't include tax and doesn't include the stock market. So I hope that kind of helps you guys. About looking at critical illness and looking at disability. They're very variable. There's different options, different price points. A lot of disability policies I put in place are 30, 40, 50 bucks. And a lot of critical illness I put in place are 100, 150, 200 bucks. So someone asked, who's the owner of the corporate CI? The corporation owns the claim and the individual owns the return of premium. So it's a dual owned policy. That's why a lawyer's got to get involved. So it's all on the Equitable website. Especially when we're working with a corporate company, a lot of people talk about, hey, my rate of return is better. When you show someone, hey, my safety is better, that's what they like that. So what are the questions you got, April? Is this
there's quite a bit of questions, but I answered a few already.
Let's attack some of these questions and try to come up with some answers.
You've got a lot of corporate questions. I think you've gotten people stirred up. But let's go back to the disability ones for the personal disability. Esther said, can a DI be a rider?
It can at IA, but you don't have as many options. You can only do 2-year payout or 65-year payout. You can't do 5-year payout. You can't do partial. So you can do as a rider at some companies. I know like Capital, you can do a rider in IA, but you don't have as many options as you do a standalone, which is typical of a lot of things. If you have questions, I want to answer most of the questions about the concept and the strategy. The specific product is a work ethic issue that you haven't read the contracts yet, and you haven't read all the brochures. Once you read all the contracts and all the brochures, all the product questions go away. So I'll answer them if they're good, but.
That's right. Vivek actually has a question, which I think he can expound a little bit more on. He said, if somebody already has DI, and if we give him only mortgage and retirement coverage, those payments will be in addition to his DI benefits, right? It won't create an issue about double payment.
Correct. Yep, they'll be integrated into it. Yep.
Okay, perfect. Well, let's just see. Encore says, this is interesting. So full premium, including corporation portion and personal portion, will be paid to personal without tax. I don't know exactly what this means.
Yep.
Okay.
The personal, the corporation would pay the premium, but it would be considered a personal benefit every year for 15 years. So the individual paid the tax on the premium, not the benefit. So yeah.
Okay. All right, so we've got a lot of product questions, which I think just read the contracts and see what's best.
Yeah.
Yeah.
Them, another time after you read the contract.
Exactly. Or have coffee or beer with Mr. Daniel. He can probably answer your question. Okay, beer. Can't drink beer. Let's see. So we've got some feedback. Really loved corporate CI concept. So you've got a lot of feedback on that. I mean, good feedback.
Mm-hmm.
See, just trying to see some questions here. Let me just scroll up for a second because there was some questions that were in the the chat, which was not answered.
Let me show you what our product looks like here. So on critical illness, we have Equitable. Can you see my the product guide here?
Yep, we can see it.
So we got Equitable. I think they're really sharp on their 10-year term. They don't have a 20-year term. So the client wants a 20-year term, but they're really slick on their 20-year term. Plus their contract is a little more robust on the cancer. Their definitions are more lenient than someone else. So they got a nice contract and their 10-year term is really in the sweet zone. IA is the go-to for, it's very flexible. You can do 20 pay, life pay, you have almost every contract at IA. So they have the most options. And IA Excellence has simple issue. And so through Assuring Go, I can do a cancer guard and then add on heart attack in one policy. Avari, I don't do a lot of Avari CI, but they do have a 10-year and a 20-year. And then La Capitale is very unique. I can do a child rider at CI at La Capitale for unlimited kids. And then Manulife has a unique. It's like they have a 5-year term on their health check or life check. It's called. And then I also have on the disability we have IA, La Capitale, and RBC. RBC is the only one that has ONOC, and they can do a $25,000 limit. And then the IA is very flexible with the product. I don't do a lot of La Capitale. I think they're priced a little bit out of the market. But then all the products we have, these are all the companies we can sell. So there's lots. There's not we don't have like a lack of products. And so how that works and the different companies, you just got to read about them. So you can start comparing.
All right. This was the question actually. That was the question I was looking for. So Raza said, if someone already had a CI payout, would they still be eligible for a DI policy?
DI is hard to get, but depends what paid out. It's if someone had a heart attack, they can likely get CI sometime or DI sometimes because that guy's not going to claim he's going to have a heart attack and pass away. And so it's different health questions. Life insurance looks for evidence. Disability looks for clues. So if you went, I got a client who got mugged. He saw a psychiatrist because he got mugged, a little bit afraid of sleeping in the dark or whatever. I make light of it, but he went to see a psychiatrist, psychiatrist, and then on the app we put that down. And so then there's an exclusion for mental health because there's a clue, but he doesn't have any. He's not mentally health. He just had a clue. He went to a psychologist. They exclude that. Life insurance looks for evidence of a problem. Disability looks for clues. So a little different on the underwriting. Let's wrap it up. One or two more questions, and I don't mind going. My day is over after this, but let's get some more questions going. I think it helps.
Yes.
It's helping.
I think we actually, majority of it has been questioned. While you were going, I was answering some questions as well. But just a few things here, maybe you can, there were a couple of people that were wanting you to repeat about the life insurance built on credibility. And Jonathan said he didn't hear the disability part. And I believe one other person also wanted you to share the illustration again for the corporate CI.
Let's start. I think about the credibility. Life insurance is a promise we make that we keep. And so if you can't keep your promises, or if you show up late to an appointment, or you forget I'm on appointment, or I forget to do laundry, so I can't wear my Titan shirt. Me and April both do our laundry on time, so we can wear the right shirt. If I can't keep up, and I always got to wear T-shirts to the meeting because I can't do my laundry on time, it's hard to sell something where I'm saying Equitable will keep their promise, IA will keep their promise. And so life insurance is sold on your ability to keep someone else's promise. Because I'm saying, if you pay this money, they will pay your family this when you die. So it's a credibility. These guys will keep their promise. If not, sue me, my will cover it. The promise will be kept. And but if you can't keep promises, it's very hard to sell someone else's promise. That's why life insurance is sold on credibility. You can't sue if you passed away. Disability is on the contract. Hey, listen, if they don't pay, we'll go to the Supreme Court. We'll go to the Supreme Court of Canada. We'll make them pay. It's a contract. It's a legal contract. And so, the better you know the contract, the better you can defend the disability. I hope that helps. Let me show the corporate CI again. Does that make sense? Is that good?
Yep, I think most want to see it again.
This is a small one, by the way. And this is also, they covered some basic life insurance. They don't have any debt. They're a healthy client, right? This isn't the starting point. But this leads into other sales too. So let's just start at the top. This is called organization, right? So I show the fact, the problem, and then the solution. The concept is this. If you have money in your corporation, it's hard to get out. That's the concept. And it's hard to put it in the market and have it go up and down. There's no guarantee in the stock market, but there is assumptions. So the client's already taking risk in his business, and if he has more money, just put it back in the business a lot of times. So I can look at the tax rates, personal rate or the corporate rates, and I can look at what the client pays and what they get. So here, if they claim they got a $500,000 policy. So I say, okay, there's 4 things that are going to happen. If you claim you get a $500,000. Now, the other thing that's going to happen is you got to pay $7,500 when your accountant does the taxes, this is going to consider a personal benefit. Kind of like a disability payment or disability, or they give you a rental car, or they kind of give you a company car. It's a personal benefit you got to pay tax on. So the client is going to pay an extra $3,000 a year in income tax. But the company pays this and it's deductible, but the $3,100 is not deductible. So you claim and you're going to pay $7,500. So what's going to happen is I can show this is what's paid. This is what the company can deduct. The client's insured for $500,000. After 5 years, you get a portion of your premium back. After 15 years, you get 100% of your premium back. So you paid in 112, you get 112 out. So now I can show here, after 15 years, you get the money back. You get the $4,000 for the benefit and the $3,000, roughly rounding off. And now you get to choose. You can do one of two things. Let me make my pen a little smaller. You can rebuy it and do it again for another 15 years. Rebuy and cancel. Or you can just cancel, or you can keep it. Let's say you're maybe overweight now. Something went wrong and you're now a lot overweight. Hey, maybe this $500,000, you want to keep it. So you have the option to keep paying. If you ever don't want it, you get your money back at any time after 15 years. You can wait for an emergency in the business, get your money back. This is considered an asset. It's both an asset. It's creditor proof because it's in a contract, but it's not divorce proof. It's considered an asset if you get divorced and your corporation's tied into that piece too. But so I can show these are some of the options you have. While you're building, you're covered. But if you don't need the coverage, you get your money back personally. And then you could keep it if you want. But hey, can you afford $7,500? I say, the question is, how much could you afford without it hurting you? Just talk to your accountant and let me know. And then they figure out what the amount is and I'll show them the illustration. But if the client keeps it till age 75, they paid in $300,000, the benefit's $500,000. They cancel at age 75, they get $300,000 out of the corporation. $300,400 if they can't rebuy or don't qualify in 15 years. So I say there's a bunch of terrible situations. None of them you lose money. Unless, of course, you can't afford it early on and you cancel it. That's what the insurance company is betting on, and they're betting that you can't manage your money because some people can't. So, but that's kind of what that looks like. The situation is you're the shareholder of a corporation who want to protect your corporation against a financial loss in the event you get disabled. The first that is critical illness insurance. The solution here, we say, hey, you get a flexible return of premium. If the insured is not diagnosed with a critical illness, the designated beneficiary of the return of premium, so there's two beneficiaries, return of premium beneficiary and claim beneficiary, will personally receive the proceeds tax-free when the option is exercised according to the contract. This says it right here. Will personally receive the proceeds tax-free when options exercised, the client chooses, and the terms and conditions of the contract. Now, that's pretty good. Strategy. First, you got to have a critical illness policy. Second, you can do anybody. You can do a key person, you can do your spouse, you can buy a few of them. But you can go in here and read some of the benefits. The tax-free proceeds are paid to the flexible beneficiary personally. The payment includes all the premiums that the corporation and the partner have paid since the date of the issue of the contract. So the premium, the corporation covers the critical illness premium. The shareholder covers their flexible return of premium. And you can choose who does the flexible return of premium on death. That's an option. And then we can look at, hey, how is it paid, the benefits? And we can start looking at tax implications and, some disclaimers and finer print. I guess whereas offices don't do corporate CI. Corporate whole life is nicer, but that's another day. I did a corporate whole life this year too. That was bigger than my CI. So I've just been blessed with this whole COVID thing. It's been wonderful. Does that answer the questions, April? Is that a little clearer as they go through more detail?
Yeah, that was definitely a lot clearer. I think the majority of our questions have been answered now. Let's just see. So just from Encore, so premium for cost of insurance is tax deductible for a corporation. Is it bought using after-tax money? Please clarify.
So it's a retained earnings. So they're not pulling income out. The corporation pays for it. So we don't usually say a corporation is tax deductible. It's an expense to the corporation, and it doesn't show up on the bottom line of profit.
Okay.
I think that answers. I think.
Yep, that does.
Hey, companies need this stuff. They went independent, and I say, what do you wish you had before you went, built a business? Man, I wish I had a benefit plan. I'm always worried if something went wrong with me, my family would be okay. What do you think your company's worth? $500,000. They think, yeah. Why don't we get a $500,000 policy and a $500,000 critical illness and a $500,000 worth of total disability in case one of these things go wrong? You're covered. You work hard for security, don't you? Or do you work hard to gamble? No, I work hard for security. Perfect. Let me get you some numbers. I don't want to go quoting rate of return too much because someone else is going to be better than me at that. But explaining a contract, no, it's very good. What did you learn today, April? Let's finish up. What did you learn? I hope you learned something. We always bounce ideas off each other.
Yeah, always. So what I learned today was a lot. I think I learned this the last time, but I think living benefits is more of an issue of, not an issue, but I guess which amount of money will show up at which time. So CI is more of a lump sum, which you use to recover or whatever you need it for. And disability is more of this peace of mind. I see disability more as a coverage that you get for peace of mind in case of disability, illness, or accident. So that's what I see it as. And of course, I learned more about corporate CI, which I need to learn more about. This is a really interesting concept, which I've never really thought about. Corporate whole life was always discussed, but I think corporate CI is something that is not really discussed, and I think it really raised a lot of ideas in our heads today for those that are listening.
I think if you invest inside a corporation and you have a minimal amount you can earn, you can't earn more than 50 grand. So if the client's starting to build substantial assets, we have to learn to get those assets out of the company so they're not earning interest and tax at the highest rate. A lot of this is covered in the 5th section of your LQP that nobody reads, called taxation. It's also covered in all the brochures on the investment company, and it's covered. All the wholesalers are like, please ask me about the big ones. Don't ask me about 10-year terms. Ask me about bonds. They're begging you, say, can I walk you through this stuff? It's fun to have a conversation about what are the ways to get the money out of the company. And what are the ways if you guys, there's a tragedy, I show up with a check, and I've been recently, last year I paid out 9 claims, last 2 years. So last year didn't count, right? But recently I show up at the funeral with a check. Usually I get that check within a week or two, and I show up at the funeral, I stand in line, and I give them the check before I give them a hug, and I don't know how else to deliver the check. It's so. Yeah, I hope it helps. If you have any other questions, I showed you some documents. If you need anything I have, it's open. Send me an email, give me a call. And when we go on a super trip, let's wear some green shoes and book that super trip. Let's all become friends. And, if I can help you in any way, talk to the brochure, the wholesaler, go everywhere else to get the information. If you can't get anywhere else, talk to your EDC, talk to your CEO, and then talk to me last. Is that fair? I love helping you last. After there's no other option, and you call me, and I know that you know, it's hard. Some things are hard to find. So,
All right.
any questions for me, April? We're good.
We're good. It's almost time. 6:30.
Yeah, some people have lots of tax questions, but we don't give tax advice. You know,
Yes, that's right. We are not
you
your
have to
tax.
you have to meet with their tax accountant, and their tax accountant will ask you if you understand, and then you
Right.
have to understand. That way, the tax accountant says this guy's not an idiot, and so that's why you have to understand, not to explain it to the client, but to explain it to the accountant. So.
Right. Absolutely. All right, that was a lot of information. I know that our brains are buzzing right now in terms of how we can help people better, not just what Daniel said, the little $50, $100 a month, but also the people, people who make a lot of money, they need our help too. I think that's a lot of misunderstanding most people make is that, oh, we can't help them. But as Daniel beautifully, showed us today, we can definitely help families. No family left behind. So thank you so much, everyone, for tuning in to Finance Fridays. So make sure that you reach out to your trainer first before reaching out to Daniel. The best way to reach out to Daniel is, of course, through Facebook community. He's always there, always active. And see you next time for the next Finance Friday. And next topic for Finance Friday is investments. So thank you so much, everyone.
By the way, if you like this, post on Facebook. Sell this meeting to other people. If the community doesn't sell Finance Fridays, it's going to stop. And so post, if you learn something, post about it so your colleagues show up to all the other instructors. I have confidence in all of our instructors. Van has done an incredible job vetting people. So I show up every Friday. So awesome.
All right. Awesome. Thank you, everyone.